Hello and a very warm good morning. You're tuned into Market Cafe. I'm Ankita Saxena, and the next half an hour I'll take you through all of that transpired in the global front, the global market moves and what transpired on the geopolitics, and of course the cues you need to watch out for before the start of the street today. But let's start with how Wall Street shaped up yesterday. Now, as far as Wall Street is concerned, we did see another day of gains coming in. In fact, we are down for another week of closing in the positive territory for the U.S. markets. As far as Dow Jones Industrial Average is concerned, that saw an uptick of 276 points, 0.5% gain coming in, new record highs that a U.S. market has been constantly hitting. In fact, Dow Jones hit its record high yesterday. S&P 500 and Nasdaq have already been sitting on their record highs or thereabouts. But S&P 500 and Nasdaq also extended gains. S&P 500 though remained closed in the flat line with gains of 12 odd points. Nasdaq also eked out minor gains. By the time it shut shop, those gains were pretty flat with just 22 odd points of an uptick coming in there. But all of these major averages are in for a positive week. In fact, for the week, if you look at it is going to be a seventh positive week for S&P 500. Dow Jones is also going to close for its third positive week, and Nasdaq Composite is also added 0.3% for the seventh consecutive week. So it's a winning streak that's coming in on the Wall Street. But remember, the bond yields have also remained elevated. If you look at the bond yields, the 30-year bond yield, that has been sitting at 5.1, which is the highest since 2007. We did see a bit of a cool-off coming on the bond yields yesterday. Before it shut shop, we did see, bond yields that have remained elevated in the last few days, though it eased to 5% last night. But let's talk about the commodities. Even oil has resumed its rally as Iran is reportedly wanting to keep the enriched uranium within the country. And on the back of that, the tensions, of course, have escalated. And on the back of that, we did see the jump up coming in on oil prices as well. Let's take a look at where oil is sitting at. Brent crude is right now trading with gains of almost 2%. $104.50 per barrel is where Brent is at. WTI is also trading with gains of 1.5% at $97.75 a barrel. So that's where crude is sitting at. So crude levels are also elevated. The bond yields are also elevated. But the surprising part is that the U.S. market still continue to rally. Let's take a look at what the Asian handover looks like, on the back of elevated crude and bond yields, though. Even Asian markets are taking a cue from the U.S. markets. In fact, traders are still assessing the U.S.-Iran peace deal diplomacy, but nonetheless, they're shrugging off the elevated crude. S&P ASX 200 is trading with gains of 0.5%. Nikkei is trading up 2%. Hang Seng is also up 0.5%, and Shanghai is also trading with gains of 0.1%. Implied start to Nifty, though, shows a very, very muted start, albeit in the green, with gains of 21 odd points. So that's what we are penciling in for the Indian market as well. But speaking of the geopolitical news, fresh tensions have emerged in the US-Iran peace talks after Iran's supreme leader reportedly ordered that the country's highly enriched uranium stockpile must remain inside Iran. The move clashes directly with US demands to move the material abroad as a part of the deal. President Trump has warned Washington will not allow Iran to retain near weapons-grade uranium, while Tehran says fears of renewed attacks have hardened its negotiating stance amid a fragile regional ceasefire. And Iran says it is reviewing the latest US peace proposal as Trump signaled he is willing to wait a few days for Tehran's response before deciding on further military action. Pakistan continues mediating the talks between Washington and Tehran amid a tense standoff over the Strait of Hormuz, where the shipping traffic remains severely disrupted. Trump warned attacks could resume quickly if the US does not receive the right answers from Iran. And Japan's core inflation showed to a more than 4-year low in April, potentially weakening the case for an early rate hike by the Bank of Japan. Core inflation eased to 1.4% below the expectation and under the BOJ's 2% target for a fourth straight month. Now, falling energy prices offered some relief there, though the strong exports and resilient economic growth continued, keeping the expectations of a future policy tightening alive amid the persistent yen weakness. And Microsoft is in talks to supply its custom-made Maya AI chips to Anthropic, marking a potential breakthrough for Microsoft's in-house semiconductor push. The discussions come after Microsoft's $5 billion investment in Anthropic and amid rising demand for computing power across the AI industry. Anthropic CEO Dario Amodei recently acknowledged the difficulties with compute as a usage of Claude AI products have been surging. And tensions are rising ahead of the French Open after several leading players decided to limit the media appearances amid a growing dispute over the prize money and player influence at the Grand Slams. Tournament director and organizers regret the move but are open to discussions. World number one Arina Sabalenka has even warned players could consider a boycott if the demands around the revenue sharing are not addressed. Ahead of the first visit to India, as U.S. Secretary of the State Marco Rubio has said that he wants to sell India as much energy as it will buy. This statement assumes importance of Rubio's visit to India will focus on energy security, trade and defense cooperation. Now, Rubio is also likely to take part in a meeting of foreign ministers of the Quad countries. Well, it's time for a quick breather on Market Cafe. You stay tuned. I'll come back with more updates on the other side. Welcome back. You tuned into Market Cafe. Let's talk about back home. In the Reserve Bank of India board is set to meet today, and there is buzz that the central bank will consider record surplus transfers to the government for FY27. Ankur is joining us with more details on that story. Over to you, Ankur.
Yes, Reserve Bank of India will decide on the surplus transfer, and this time the market expectation is anywhere between 2.8 lakh crore to 3.2 lakh crore. Now, even the last year there was a record surplus transfer to the government by Reserve Bank of India of 2.69 lakh crore, but this time the anticipation is even higher. If you look at the budgeted estimate, the overall dividend transfer expectations including PSUs is somewhere around 3.05 lakh crore, but the market is anticipating that Reserve Bank of India, after accounting for all the gains which it has this year, may be able to transfer somewhere close to the amount of 3 lakh crore. Now, importantly, last year Reserve Bank of India did maintain the contingency risk buffer of 7.5%, which is the highest level suggested by the Jalan Committee, and accordingly we need to wait and see whether or not this year the same approach is adopted by Reserve Bank of India. If you look at the last 5 years of the dividend transfer, of course the last year was 2.69 lakh crore, but before that 2.11 lakh crore, and there has been a transfer of 87,000 crore, 30,000 crore, as well as 99,122 crore in FY21. So we need to wait and see how much of the amount actually Reserve Bank of India shells out for government this time.
All right, Anko, thank you so much for joining us with that. Let's move on then. SEBI is also proposing changes in the special pre-open session for better price discovery for IPOs and relisted scripts. Ankur is joining us yet again with the details of the story. Take it away, Ankur.
Yes, market regulator SEBI has proposed that there should be overhaul of the price discovery mechanism for real estate shares as well as IPOs. Now, what is the suggestion for real estate shares? Market regulator is saying if at all the time period is within 6 months, the last price should be taken as the base price. But if the time exceeds beyond 6 months, market regulator is saying that 2 independent valuation reports should be there, and therefore the base price should be assessed accordingly. Also, there is a proposal to empanelment of valuation agencies, chartered accountants by exchanges for the valuation process. Now, as far as the dummy price band method is concerned, market regulator is saying that that can be continued, but the catch is the orders which comes either at the upper end or the lower end of the price bands. Now, how to navigate that problem? Because SEBI had given instance where there was observation that at the upper end of the order, if 90% of the order comes and it gets rejected because there is no acceptance of those order, now there needs to be an overhaul which is there, and therefore what SEBI is proposing, they should be flexing, auto flexing should be there for 10%. So meaning if the band is till 200 till 210 or 15, there should be automatic flexing whereby those orders are accepted. The idea is for a better price discovery for both IPOs as well as real estate shares, and therefore SEBI has come out with consultation paper whereby the suggestions can be given till June 11.
All right. Thanks so much for that, Ankur. Let's move on and talk about all the stocks that will be in focus in today's trading session. For that, my colleague Karan is now joining us. Karan, take it away.
Well, let's start off with the Q4 earnings of Prestige Estates, wherein the revenue has more than doubled to 4,000 crores and the net profit has also increased significantly to nearly 300 crores. On the flip side, the EBITDA margins have contracted significantly and the FY26 pre-sales stood at around 30,000 crores versus the company's guidance of 27,000 crores. Followed by Happy Forgings, wherein the company has delivered a strong set of numbers. While the revenue is up 20% at 424 crores, the EBITDA margins expanded by more than 200 basis points. The company has enhanced its captive solar power plant investment to 170 crores, which is equivalent to 35 megawatt, and the management expects the overall margin impact to remain manageable. Followed by Varun Beverages, wherein the company has extended the exclusive bottling pact with PepsiCo till 2049. The deal has been extended by 10 years till 2049, giving the company a long-term business visibility. The revised pact also removes the restrictions on the company to do non-PepsiCo business, allowing it to explore certain other opportunities as well. And finally, we have Central Bank of India in focus, wherein the Government of India has launched an offer for sale for the company. The offer for sale is scheduled for May 22nd and May 25. Retail investors can bid on Monday, and the government offers to disinvest 4% equity in the company with an additional 4% as a green shoe option. The floor price is set at Rs 31 per share at a discount of 8.5% from the last closing price. Currently, the Government of India holds 89.27% in the company, and post the OFS transaction, the stake will eventually fall down to 85.27% or 81.27% stake in case the green shoe option is exercised.
Thanks, Karan, for joining us with that. But let's also talk about earnings and the earnings candidate. And it was a robust Q4 for Page Industries as the revenue and PAT beat the street estimates while the margins lagged. Meanwhile, the LG Electronics reported a weak Q4 with margins contractions, while Honasa and Nykaa reported a strong Q4 results too. My colleague Ashesha is now joining us with more details and number crunching for these companies.
Well, yes, first up, let's talk about Page Industries, and this counter has reported strong set of numbers, much ahead of what the street was working with. Revenue growth of about 14.1% on a year-on-year basis, and margins too have remained steady at that 21% mark. Now, remember, sales volumes in the fourth quarter saw a steady increase of about 11% on a year-on-year basis, and the management says that they are confident of sustaining this kind of growth in FY27 as well. Inflationary pressure continues to persist, but they are saying that they are well positioned to manage these challenges via sourcing methods and pricing action. So clearly, good set of numbers that Page Industry reported, and the management outlook for FY27 is also very strong. Shifting focus to LG Electronics then, and it was a weak quarter for this counter. Revenue has seen an uptick of 8%, but it was below what the street was working with. And margins too have come in at 11.7% versus street expectations of about 13%. So it's a weak quarter that has come in for LG Electronics in the fourth quarter. Honasa Consumer has reported strong set of numbers, revenue growth of 23%, EBITDA growth, in fact EBITDA rose by about 3 times on a year-on-year basis, and margins too have come in at 11.7% versus street expectations of 10%. So across the board, it's a big beat when it comes to Honasa Consumer. Lastly, let's talk about Nykaa. Strong set of numbers. Management commentary from the con call is also very positive. Revenue growth of about 28%. Margins have come in at 8.5%. We were working with a figure of 7.9%. So margins clearly have beat street estimates. As I mentioned, management commentary was also on the positive side when it comes to Nykaa. They say all business verticals are showing strong margin expansion, and they see good headroom for consumer acquisitions and growth as we head into FY27. So strong set of numbers and strong management commentary is what Nykaa has reported.
All right, so those were the results for these companies, and these are the stocks that will be watched out closely by investors on how they're moving on the back of their earnings. But But let's talk about LIC also, that posted a strong Q4 with value of new businesses jumping 67% and the margin expanding sharply to 25.7%, comfortably beating the street estimates. Management said that the focus remains on improving ticket sizes and persistency through agency rationalization. Mithali is now joining us with the highlights.
Right, so India's insurance giant LIC has produced blockbuster results for Q4 FY26, led by a sharp expansion seen in the company's profitability margins. The biggest surprise, it came from the value of new business, or the VNB margins, which jumped to 25.7%, a rise of around 7 percentage points year-on-year, significantly ahead of the street's estimates. The improvement was actually driven by a strong traction seen in the high-margin non-par business and also favorable yield curve movements. Annualized premium equivalent, or what is called the APE, rose a healthy 22% yearly, while the full year APE, it grew around 18%. Thanks to the margin expansion, quarterly VNB surged nearly 67% on a yearly basis. The embedded value, it however saw a modest growth of around 1.6%, impacted by the adverse economic variance. On the shareholder front, LIC announced a final dividend of ₹10 per share that will be post-bonus adjustment. The record date for the bonus, that will be 1:1 bonus, is set to be as May 29th. Management says the focus now is not just on the margin expansion, but sustainable growth in the absolute VNB. The strategy going forward will center around high-ticket policies, improving persistency, and also calibrated product mix improvement. Importantly, LIC continues to stay conservative on solvency. The solvency ratio, it improved to 235%, but the insurer, it remains cautious ahead of the transitioning of the upcoming risk-based solvency framework. So overall, if you see company's results for Q4, it signals a strong shift in LIC's profitability structure. Back to you.
All right, Mithali, thank you so much for joining us with that. Let's talk about another earnings candidate, Max Health, that reported a mixed fourth quarter, missing the street estimates despite healthy double-digit revenue and EBITDA growth. Meanwhile, Aurobindo also reported an inline set, with revenue rising 5.6%, while margins softened due to higher R&D investment in the biosimilars and specialty products. Meryl is now joining us. Mithali is joining us yet again with the street's verdict.
Right, so two major health players, Max Healthcare and Aurobindo Pharma, have delivered their Q4 FY26 numbers, with both the companies continue to invest aggressively for their long-term growth. Starting with Max Healthcare, the company's revenue, they rose nearly 12% on a yearly basis, while the net profit saw a relatively modest rise of around 7%. The EBITDA was up at a stronger 18.5% yearly, with margins expanding to 28.3%. However, the quarter, it largely missed the street expectations across the revenue, EBITDA, as well as on the profitability front, with profitability being impacted by the aggressive clinical hiring and also the cost linked to the expansion. Operational metrics, they remained healthy, with bed occupancy at 75% and ARPOB stable at around 78,000 rupees. Also, the company added new 400 beds in the last year, taking the total capacity now to over 5,000 beds, and also completed the acquisition of the Kalinga Hospital in Bhubaneswar. Meanwhile, talking about Aurobindo Pharma, it reported a broadly inline quarter for the results of Q4 FY26. Revenue for the company, it rose around 5.6%, while the net profit increased 2%. Company's EBITDA margins softened to 19.8% due to the continued investment seen around R&D as well as the specialty expansion. The US formulations business remains strong, with 9 ANDA approvals and 12 product launches during the quarter. The company also continues to invest heavily in its future growth areas like biosimilars and biologics manufacturing through its Theranim venture. Overall, both companies are seeing near-term margin pressure as they invest aggressively to build, scale, and strengthen the long-term capabilities. Back to you.
All right, let's move on then and talk about Dalmia Bharat, that will be in focus as it is set to acquire Jayaprakash Associates cement capacity in central India from Adani Group for over 2,800 crore rupees. My colleague Ashesha is now joining us with more details on that.
Yes, Dalmia Bharat will be in focus, and as you mentioned, the company has said that they will be acquiring Jaiprakash Associates Central India cement capacity at an enterprise value of about 2,850 odd crores. Now remember, this comprises of plants of Jaiprakash Associates that are located in Madhya Pradesh as well as in Uttar Pradesh. As far as capacity is concerned, the total acquisition will have a capacity of about 5.2 million tons per annum. That's the cement capacity. And as far as clinker capacity is concerned, that will stand at about 3.3 million tons per annum. Now, as I mentioned, enterprise value is at about 2,850 crore rupees, and considering capacity of 5.2 million tons per annum, that's the cement capacity, the valuation comes to about $57 per ton, and that's cheap as compared to the other acquisitions that have happened in the cement industry. So from a valuation perspective, it's a positive for Dalmia Bharat, the company which is acquiring assets of Jaiprakash Associates. Now, the asset also has about 99 megawatt of thermal power capacity, railway sliding at Rewa and Chunar, and common railway sliding at Churk. So these are some of the other assets that the company will be getting as a part of this acquisition. Now let's also understand how this will benefit Dalmia Bharat. One, of course, valuations are on the cheaper side, and second is also on the back of presence that it will now expand in central India. So that is another positive. The company has already laid down its capacity expansion plan, and in line with that, the company will now be increasing capacity to about 55 million tons per annum. So that's another positive. So yes, big news that has come in for Dalmia Bharat. This acquisition news, 2,850 crore is the acquisition, and the valuation stands at about $57 per ton.
All right, let's move on then from Dalmia Bharat to Tata Sons chairman N. Chandrasekaran and Noel Tata that are all set to hold key discussions ahead of next week's Tata Sons board meeting, with governance and strategy listing related issues likely to dominate the agenda. Ankur is joining us with the details of this meeting.
Yes, sources say that Tata Sons board meeting is set to happen next week, and the key agenda is likely to be the listing of Tata Sons. Remember, this has been a pending issue for very long. September 2025 was the deadline as far as the list of NBFCs is concerned, and after the deadline, the company had requested for a waiver from Reserve Bank of India to deregister itself as CIC NBFC from the list of NBFCs, but we do not know yet that whether or not regulator had given that exemption, because in the list of last list of the upper layer NBFCs, Tata Sons was a key company in that, and therefore it is interesting to see how Tata Sons wants to move ahead as far as listing is concerned, and for that we understand there is going to be a discussion in the board meeting which is set to happen. Apart from that, Noel Tata is likely to raise the concerns around Air India losses and Tata Digital performance in the board meeting, and remember, this was a point which was raised even in the last meeting of Tata Sons, and we understand that there is likely to be a presentation which may be made by N. Chandrasekaran to the board regarding the performance of the group companies. But all in all, the meeting is set to happen next week, and it will be interesting to see what decision Tata Sons takes, especially on listing.
All right, thanks Ankur for that. But with that, it's time to pull down the curtain on this edition of Market Cafe. I'll take your leave. Thank you so much for tuning in. Don't go anywhere, because the market is coming up next.